So hi Mike, thanks very much for having me on today to talk about greenwashing. My name is Peter Rawlence and I'm an investment manager with the positive change strategy at PICTET Asset Management. For those of you that don't know PICTET, we are somewhat of a pioneer within sustainable investing, predominantly through our thematic equity franchise, where we invest, whether it's through a single theme such as water or a multi-thematic approach such as global environmental. We've been doing that for a number of decades.
As I've done a few of these, it's probably a bit daft that I'm going to introduce myself, but I'm Mike Head and I'm the Managing Director of Ethical Screening, which is a company that provides screening and research on both equities and funds and bits and pieces. And this is a window into the funds portal that we provide, which is a tool which is sponsored and free to use for advisors. So it's a way that they can select funds based upon criteria and other guidelines, and then that they can, the purpose is that they can use this to look at more contemporaneous sort of soft fact. It's not a place where we have fact sheets and all the rest of that financial data. It's a place where you look and think, oh, PICTET, I never heard of them. Who are they? What do they do? Why do they do it? Why do they do it that way? And stories. The thing that we know from talking to clients, the thing they find most interesting is not the Sharpe ratio, it's why do you buy that company? That's interesting. I wouldn't have thought about that. And sometimes the thing I think that clients find most interesting is not, oh, that's to be expected. It's a wind turbine producer. It's a, oh, I know that company. I wouldn't have thought they were that good. And that sort of thing, it's almost more rewarding when you discover that a company that you're actually a customer of, take a Unilever, for example, as being quite a famous one, that lots of people use Unilever, but they wouldn't know that Unilever does an awful lot of good stuff, and they put them in that either quite dreary or actually quite bad category. And obviously with things that are going on at the moment, the reason I'm talking about greenwashing is because there seems to be a sense that either there's a lot of it or there's too much of it, and we've got a regulator that is saying we need to do something about that. Do you get accused, I suppose is the first point. Does it come up very often with PICTET? Is that a question that investors and the like pose?
Yeah, I mean, not absolutely. It's not a question that I think we get accused of a lot, but operating within the sphere of sustainable investing, it's certainly a challenge that you have to approach. And I think I kind of want to kick off with how we understand the definitional aspect of greenwashing, because often it's become synonymous with investing within dirtier sectors while claiming to be sustainable. But actually, I want to kind of focus on the fact that greenwashing is really around producing unsubstantiated claims about having more positive environmental impact or even social than you do in reality. So it's that mismatch of information, whether on purpose or by accident. And I think it's critical to come back to the kind of dirty point that to get to a sustainable future, we're going to have companies that make those claims and want to change. And so the only real way that we can clear out this kind of gray area of companies that are on that transition is through transparency. And I know people who've been on this call have said it before, but I think making sure that you're very clear about the definitions in advance of a client investing as to why you're investing in a specific way, so that you have the mandate from them, very clear about the process that you go through to deliver that is incredibly important. And then finally, showcasing after the fact, post, what it is that you've done, reporting on that very strongly. And I think this whole transparency element is going to affect across the value chain. So whether that's at the company's basis, which is more disclosure, at the regulators, which is setting clear and understandable frameworks for people to operate in, or us to our clients reporting, it's going to be critical. And that will only assist us as active managers to further our due diligence and ascertain that these companies really have the capacity, willingness, and ability to transition to the future. And so to come back to kind of the point of how greenwashing, how I interact with it on, let's say, a daily basis, there are two kind of key areas for that. The first one is the interaction of information between the company themselves and us as the asset owner or the fund manager, and then how we report on our kind of portfolio amalgamation of information to our clients. So beginning with the companies, the way in which we try and solve that on the positive change element to kind of break through all the marketing and the green labeling and the like is to firstly focus on the products and services. You can put the word green in front of anything and try and make it sound sustainable, but you cannot change what your actual products and service impact that it has on the ground. So we focus specifically on what the business model does and what they're actually selling. And the other way of, potentially obfuscating really what's going on is having a biased approach to understanding that product and service. So to strip that away from us, we have developed a relatively unbiased method of doing that. We've built a proprietary natural language processing tool that helps us to categorize companies and their products and services against the sustainability framework, which in this case is the United Nations Sustainable Development Goals, which is basically the best framework that sustainable investors have today. That kind of automated process is very scalable. It's backed by academic research, and it strips out my own personal kind of biases as Peter Rawlence as to what a product and service might have. And then the other piece of that is that tool will also flag to us not only the positives that a company has, but also the negatives. We don't, part of greenwashing is only focusing on the positives and just pretending the negatives don't exist. We find it fascinating to see, in the delivery of your positive exposure, let's say a contact lens manufacturer, you're delivering positive health benefits. But if we don't talk about the plastic waste that ends up in the sea from that contact lens manufacturer, then we don't have a full holistic understanding. So we really also go after the negatives, because we think that it's just as potent to reduce the negatives to maximize the positive as it is to focus on the positives. And then very briefly, on our interaction with our clients and how we translate that, again, it's completely about transparency. It's transparency on our philosophy. We're very clear that we expect to outperform on the basis of our companies improving their impact alignment. We break them down into categories so the companies are very easily understood in how we perceive them. So that's leaders, those that are already aligned, improvers, those that are undergoing the transition, and then opportunities, those that are yet to begin the journey that we engage with heavily. And finally, we provide a full holdings list for all companies that we hold within our portfolio that break down not only the description of what the company does, but also how we perceive them from an impact perspective, what we expect our investment case to be, because the two are inherently linked, and where you should expect to see improvements, not only on a UN SDG basis, but also on a company-specific basis, so making it very relevant to their business model. So that's really how we understand greenwashing and how we try to tackle any accusations that may end up coming our way.
Yeah, I think that point you made towards the end there, which is a good brief point, by the way, where you said about the fact that you provide a list of holdings. I think that there's been some interesting pushback around the idea with the labels of unexpected holdings. And there shouldn't be, everything is unexpected to somebody. So trying to categorize what unexpected is, the only way you overcome that is by everybody producing a list of, this is where we invest, this is who we invest in, and this is why. And you do it a bit warts and all, because the reality is there is no perfect company. So it's always shades. And it's this problem of the marketing department's trying to pretend you stick an ESG climate change label on. People don't know what that means, but they imagine it must mean that it's positive for the climate, and they would expect man in the street, person nailing themselves to, or sticking themselves to a motorway, that it's not going to include oil and gas and coal, and yet it does. And it's that part that I find really frustrating. I think the other bit that's interesting is, I think there's no question some of the greenwashing is intentional, but some of it's unintentional. There are. If you're a PICTET, you have the resources to be able to do all the things that you're doing. If you're a smaller asset manager trying to get a decent level of alignment and buying data that doesn't necessarily include double materiality, if you go on the score, some companies that people would look at askance tends to get through. I think the other thing that's interesting, which is going back to the point we were talking earlier about this newly launched fund of yours, is I think there's much too much of a tendency at the moment to be a bit binary about this. It's got to be no bad, only good. And as much as the FCA might like to tell us that 80% of people want to invest solely for good, the experience of the number of people who actually do and the amount of money invested there means we're not going to get there if we only invest exclusively into the most sustainable, greenest companies in the world. So having funds that are in the middle ground, that are accepting that we're driving our motor cars, but we don't want any oil. And we want all the nice things, we want to go on holiday, but we're all going to swim there. It seems a bit odd. And it's that thing of the point you're making, your different categories of the sort of the leaders, the improvers, etc., and those with somewhere to go. If we only go and the investment universe becomes exclusively the leaders, it's a very, very narrow pool. And I think that's something that people need to be aware of, because we're only going to bring the majority along if we make it something that appeals to the majority, rather than just that appeals to those that either can afford to or who have a level of commitment that matches.
No, absolutely. And I think you made a really interesting point at the beginning around the unintended, companies that you hold. And by only focusing on the best in class, let's say, you absolutely can't, operate with many companies throughout the economy, right? Because as you mentioned, no company is perfect. And often the ones that find themselves into a best in class approach are low asset intensity, software related and the like. So you have this, firstly, high level of crowding within that from sustainable investors, which basically arbs away all of the returns. So you sacrifice potential upside there. But also, in reality, that won't make significant changes. And then you have a fund that is inherently implicitly biased to a specific style, a region, or a geography. And so it may be in vogue for a year, maybe two, but then you will have a rotation, as we see throughout economic cycles, that will leave you lagging the indices. So in order to have a balanced approach and to help drive that shift, we like to take this whole economy approach. And I think it's about ownership, as you say, of the warts and all, right? I think being very clear to your clients about how you understand this company, so that they can maybe bring to you things that you didn't understand, is actually a positive thing. We shouldn't kind of be fearful of the mistakes. We should lay our cards out on the table and say, this is where we expect them to go. And it's not necessarily a secret sauce. The secret sauce is in the delivery of that. And so I agree with you when people who only publish their top 10 holdings, or they kind of try and have a bit of smoke and mirrors about their full portfolio, we welcome the scrutiny. We don't believe that publishing our full holdings list of 40 companies that we do today provides you with any edge against us. Our edge is our deep fundamental research to understand the value drivers and the business to a higher degree than others, and the relationship that we hopefully can build with that company in order to affect change. That can't be replicated. That is something that we spend a lot of time doing. And I do think that this increasingly will be a larger part of the market, because as you mentioned, there's a significant amount of money that does not necessarily want to go the best in class because they have certain financial KPIs that they need to meet. And the FCA, we're not covered by them because we're a European domiciled fund, but are focusing part of their labeling also on this improvement category, looking for companies that can undergo that change. And so we do expect that there will be further kind of momentum behind this area, and we welcome that, because that is what's needed for the transition of tomorrow, right? We still need all of these companies. They just need to change their behavior.
I think that my thing is, and I've said this for a long time, managers need to be more proud of the companies that they own, rather than just having a list and it being, it's these, whether it be a top 10 or the whole list. Just having a list of names that are reported every year doesn't really mean anything. And I think as well that what they can do is they can actually lead not just investment, but also sort of in a slightly grandiose way, societal change, because people who want to, who knows which is the best supermarket? Okay, you can maybe buy a which survey, but that looks more at price. It doesn't look at sustainability. Which is the best oil company? Which is the best utility company? If all of those were held, for example, in a fund, and you could look and say, oh, that's interesting. I wasn't aware that Sainsbury's were much more enlightened about organics or about sourcing or about any of the other outputs that they measure. And as a consequence, as a consumer, I'm thinking, not only do I want to invest into this fund because they hold that company, but I actually want to be a consumer. So it benefits everybody, and it benefits the companies as well. And that's the bit where change comes too, because if we do need our oil companies, annoyingly, it would be lovely not to, but the reality is we do. And I think that I don't disagree with many of the protests, but the problem is it's hard for people who haven't, maybe people not within the industry, to understand that there are the BPs and the Shells of this world that get a lot of grief are probably at the better end of the scale, and they are just lumped in with they're an oil company. And the stuff that's come out in the last couple of days about Chevron and the view around what they're doing with offsetting and the like, then it just feels as though helping people through where they invest into how they lead their lives is actually a positive thing. And I know that if you look at individual client profiles, they're delighted to know not just where their money, but then to think their invested money, but their spent money is an issue that feeds into it too.
Yeah, I completely agree. And I think, if we take all as an example, I think having capital that goes into that helps then affect change, the marginal impact of the pound that you put towards that is going to have significantly more impact than investing in another green leader. And, I completely agree with you. We want to stand up and be counted, and we're very proud of the engagements and the work that we do with companies. And if I can, not by name, but give you an example of an oil field services company that we work with and why we're proud of that. This is a business, it's one of the top 3 in the world. They do, the legacy part of their portfolio is doing drilling, exploration and production for these super majors, right? And so it has that negative exposure to legacy energy. But through that technological understanding and the development and some acquisitions in the past, the other 50% of their business is through compression technology, which today is liquefied natural gas, which has a transition element to it and is a social security as well for Europe at the moment. But that also means that they are the leader in hydrogen compression, so the fuel of the future. So this is a company that on first blush, you'd kind of knock out because they have oil exposure, but really they straddle legacy energy all the way to the energy of the future. And once we'd identified that through the natural language processing tool, we reached out to the management team for a bit of an introduction, and they were, incredibly excited to partner with a sustainable company because they wanted that oversight, they wanted encouragement, they wanted the sort of expertise that we might bring to the table. And even though we're one of the smallest investors, because we're very new on the table, we managed to meet the CFO, the chairman, the CEO, and the entire ESG team before we even invested, to ensure that they were happy to get on this path towards improving their business model, reducing the emissions and the exposure that they have to oil, and redirecting those profits to invest behind the future. So an orderly rundown of kind of legacy business and investing hell for leather for a sustainable future. I'm grateful to say that through that kind of engagement and that collaboration that we've had with the company, they've already signed off basically on 2 of our key KPIs, which is increasing that organic investment into the new energy portions and setting targets for the reduction of emissions for their legacy business. And so that's really where we believe we can see change, right? Is working with a company that has their hands in this sort of industry, that wants to change, has the capital to change, and just needs a helping hand.
It's really useful having somebody explain. One of the biggest problems about engagement is people imagine that engagement is just the step towards disinvestment. That engagement is about changing behavior. And it is to an extent, but it's much more nudge than it is just straight push. And it's that element that people say, well, if you're engaging with them, show us that you've got them to change. And the reality is, you don't just go into a boardroom of a huge multinational company and say, stop doing that. And they say, oh, fair enough, we will then. But also the fact that, as you pointed out, companies really like having that conversation and understanding. It's quite interesting that the level of expertise now around sustainability and the transition and where we're heading, a lot of that lies within the investment industry. So that although you've got within the organization you're talking about there, they've obviously got the scientists and all the rest of it. They don't necessarily have the same vision because you're in a product production marketing world that's different to theirs. They're making something that people consume. Yours is something that people have to have faith in to therefore invest into it. And the other thing, of course, that's interesting is you look at that in terms of transition. Because I'm an old person, nuclear was always the don't go near it. The view of investors has changed enormously over the last 15 or 20 years because I think most of the investors in the sort of the core sustainable world would see new nuclear as not being a great place to be, unless it's some of the very, this small thing that Rolls-Royce are maybe going to change the world with. But they see it as the perfect transition fuel, because if it's a transition source, if it's already made, let's minimize the output, let's minimize the impact. But that means that we don't have to burn as much coal and as much oil and gas. So let's move in that direction, which seems like a great way to be going.
Absolutely. Coming on to, to your point about engagement, we completely agree. Engagement is not about going in there and pointing fingers. Engagement is inherently about collaboration. Help us to understand why you do the way you think, the things the way that you do, and we'll help you understand why we believe you can change. And I think one of the things that really plays into that conversation is having this long-term perspective and the knowledge that you're going to be around for that transition and stay with the company while they most likely have to make some investments. Then you're there to reap the rewards, and also that you have a kind of track record of working in this area. I think, also that you have an active approach to it, right? At the end of the day, we're the ones who are deciding that this is an appropriate investment case, and I'm also the one sitting across from, whether it's the C-suite or the ESG team, talking to them, understanding what that means for our investment case and our impact case, and feeding back to them. So you have this very synergistic understanding and kind of collaborative relationship. I think, as you mentioned, a lot of people go in there and say, well, you need to change this, you need to do this, and otherwise it's like divestment. Inherently, the company will have a significant amount more of information than we do, right? We're not technicians. I'm not an engineer. I'm not a scientist. But what I do is I have a long-term perspective. I have accountability and a scrutiny towards this company to ensure that they're doing what they do. That doesn't mean that I don't corroborate my understanding with external third-party specialists to make sure that I'm understanding of the capabilities of change. But I think it's very important to listen to the company about what is actually within their capabilities and what's not. And I think, yes, that is the kind of carrot of we'll work with you and we'll invest with you and we'll stay with you through that kind of period of investment before you hockey stick, hopefully. But it is also very important to have an escalation policy, to have the stick there as well. And so every engagement we go into, we have a predefined set of criteria, KPIs firstly, and then escalation steps that we will enact if a company is not kind of proceeding. Because some companies do say, yeah, of course, invest with us, we'll definitely do that, and then go quiet. And so there are many ways to reach that before divestment. And actually, we would prefer to do things like collaborate with other shareholders, work towards putting things on the proxy, forcing the board to listen to us as shareholders. And divestment really is the kind of last step for us. And that's a shame, because often when we identify these companies, we believe they have a role to play in the future for all of our transition. Divestment means it's kind of a lost case. But that's also because it's our investment case. And if they don't transition, we don't really see the financial upside. So certainly engagement is an incredibly useful tool, but it is more nuanced than maybe it appears.
The one I love most is when I have meetings and someone will say, we've been engaged. You get I don't know, 200 billion assets under management firm saying they've been engaging with, I don't know, Tesla or Amazon. And you think, hang on a minute, the man who owns it has got more money than you manage. I don't think he's going to listen very closely when you say, I think you should pay people a bit more or stop tweeting nonsense at midnight. It's very strange, that one. And I'd say I think there's a real job that the industry in general needs to do about engagement, about explaining that is what it's about. It's about moving people along, and also at the point of saying, okay, if it turns out that in 5 years' time we've been engaging with these people and all we've had is some very expensive lunches with some very savvy suits and they've not changed anything at all, then it really is time to say we're not going to invest in you. Because actually, if you haven't changed in that time, then you've decided by engagement where you think that company needs to be to make it more profitable. It's not going in and telling them to run their company, because if you were that arrogant, you'd be running a company or that successful, you're running the company yourselves. But it's saying that these are the types of things that are going to make you a more successful, more appealing, more investable firm for us as a big asset manager. And if you don't think that those things are going to be part of you where you are heading, then it's probably best that we part company and we'll find the company that is going to do that in the same sector as you. Because as you know, the disruptors and the competitors are the ones that are going to be making the difference certainly as far as the climate transition is concerned.
Absolutely, and I think that speaks to the method that we approach kind of engagement with, which is that we have to ascertain before we invest in a company that they have the ability, namely the balance sheet and the profitability to finance a transition story, but also the willingness, and I think to your point on kind of engaging with companies that have significant shareholders that do not follow that, it makes it almost impossible for them to want to change if you're fighting that sort of area. And so we look at a multitude of kind of corporate governance areas and talk to management to ensure that, yes, this is someone that we want to partner with. But I think also it's not to say that there can't be a David and Goliath story here. I mean, we've seen that through engagement in the past couple of years, proxy votes being put on large oil companies by very small shareholders. What I think is critical also is to understand how aligned you are with the other shareholders. And that can be sustainable shareholders. Do they want to move them to a kind of better world? But also what's really important is to tackle changes that also have impacts on the material value drivers. Because there may be 60% of the shareholder base who are passive, don't vote, don't really kind of get involved. If you can put forward a case that transitions the business to doing better, but also that generates outsized returns that will turn into outsized share price performance and potential material re-rating of valuation of that company, then that's an incredibly attractive proposition for both camps. And so that's why we think a very kind of active approach to understanding the impact case, which becomes the investment case, and the engagement case in advance of investing is critical within this area.
Well, it's the thing, isn't it, that the people who run these companies want the share price to increase. It's not as though they're quite happy to see it tanking. So if people come along and they put forward resolutions through engagement, through dialogue, whatever it might be, that they're going to make the company more profitable, they're hardly going to say, oh no, we only got our own ideas. It's a closed loop here. So don't you come along, young man, with your fancy Dan ideas. It's like, that's a great idea. We'll steal that one. We're not going to tell anyone else, but that's how it works.
Yeah, and if they don't listen, hopefully, the multitude of other shareholders on the register who are the ones who have the power to vote, they will like the sound of that, because their fiduciary duty for the most part is to provide capital returns for their clients. And so they're hardly going to turn down, the dual sustainability of financial sustainability and socio-environmental sustainability as well. So that's really what we're trying to target, is that kind of combined outperformance on returns.
Well, it's the thing, which is a good place to end, which is your job's to make money and minimize damage. It's to try and match, which is sometimes a bit of a mismatch, but that's the ultimate game. But need to not lose sight of the fact that this is about making money with people's money. So that it would be all very well investing into a nice crofting operation on the Scottish Hebrides, making items out of moss, but it might not make much money. And it's trying to make lowest impact money out of real world solutions. That's what it's about.
Absolutely. I mean, our clients have already made that capital allocation decision. Should they want no financial return, they would invest in a philanthropic exercise. They have invested with us for the specific goal of meeting their financial targets in the future, whether it's retirement or any other way. And so our method, as you correctly point out, is making sure that we can deliver financial returns for that without sacrificing the sustainability of their life in the future, right?
I think that'll do. Thank you very much. That was good.
Thanks, Mark. I really appreciated that. That was a good conversation.
Nice to talk to you. Good tie as well.
Thanks very much.